The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
And just like that, the second half of the year has started live from Studio 2 here at Bloomberg headquarters in New York. I'm Katie Greifeld.
And I'm Bailey Lipschultz. We're kicking you off to the closing bells here in the U.S. with the best hour of Bloomberg television. S&P 500 basically unchanged on the day. Big drag, though, has been semiconductor stocks, Katie. They had been rallying, but been kind of a dance back and forth. But keeping an eye on the Philadelphia Semiconductors Index, down more than 6%. A lot of weakness, a lot of jitters, in part driven by the fact that Meta, according to Bloomberg News, potentially eyeing their ability to sell off some of their AI compute. Big news for the company to the upside, up about 10%, but again, weighing on the chip makers and also just keeping an eye on all things energy. Brent crude right now down 2%, still floating around that $71 handle a barrel. But Katie, all things kind of at least waffling, as if you will, to kick off the second half of the year.
And we'll see how long, we do waffle here. Since you think about July, it's been the best month for the S&P 500 in the last 2 decades. The index, it's experienced its last July loss back in 2014, so quite a track record. But this year, that track record, it's actually meeting worries that a confluence of market-moving events will whip volatility in the back half of the month. That's the same times that the next earnings season kicks off, and also the same time as the Federal Reserve's next interest rate decision. And speaking of the Fed, Chairman Kevin Warsh saying today at a conference that inflation risks have come down. On the other side, though, Citadel Securities saying that investors are actually underestimating the likelihood that the Fed could raise interest rates as soon as this month due to Warsh's adaptive framework.
I do want to say, at least for the United States, this is a time of huge opportunity. And if the Fed can deliver on its remit to deliver prices, I've never been more optimistic about what the growth engine of the U.S. could produce.
And data out today showing economic strength, with the manufacturing data holding close to a 4-year high in June, and jobs data showing private sector job creation was solid again this month. Now, tomorrow will be the real measure of the labor market with that June jobs report coming on a Thursday, not on a Friday, Bailey.
Not on a Friday, when I will still be here in the studio on Thursday, helping to break down the close on that July 2nd. But Katie, I want to talk about the market. As you can see, at least today, the Mag 7 outperforming, again, really driven by that rally for Meta, but keeping an eye on the month that was June. Terrible, terrible, terrible month for the Mag 7 large cap tech companies. Worst month performance relative to the market since late 2022. Hoping to right those wrongs, Katie, but this is a market that maybe has been expanding. We're seeing maybe a little bit of outperformance for equal-weighted stocks as the big boys lag. But the big question is this a market that can continue to punch higher without the performance from those big 7 companies?
Well, let's pose that question to Liz Ann Sonders. She is Chief Investment Strategist over at Charles Schwab, joining us right now. Liz Ann, great to speak to you again. So you think about seasonality, certainly on the side of the bulls here, but, should we continue to march higher when it comes to the S&P 500? Really curious to hear your take on what that leadership actually looks like, because below the surface of the index, certainly it's been a pretty interesting mix.
Yeah, and that's why we've been referring to it as the duck market, fairly smooth on the surface and paddling like the Dickens underneath. I think that was a Michael Kayne phrase initially. And these rapid fire rotations, we've seen a blowout on the upside in terms of dispersion, a blowout on the downside in terms of correlation. And that's happening not just broadly across the market, but within sectors and within industries. And I think that kind of backdrop where you continue to get a grind higher, but you really have to look under the surface to get a fuller story of what's happening given this massive rotation that we're seeing.
And you point out in your notes that you take a look at mega caps, the S&P 500, the momentum factor. Typically, they tend to trade together, but certainly we've seen that correlation disconnect over the past year or so. And then you take a look over the past 2 weeks. Momentum really hasn't been performing as a factor. I wonder what you make of that slippage there and whether or not you would expect it to continue.
Well, that's the nature of rotation. I think there's something misunderstood about the momentum factor when people talk about it. I think when people hear momentum, they automatically assume it's high beta tech stocks. When the momentum factor is working, it's more of a concept. It just means that things that have been working continue to work. You can have momentum in utility stocks. You can have momentum in consumer staple stocks. So it's not always the high beta. When you lose that continuous outperformance and you move into a rapidly rotating market, that's when you see that disconnect between the momentum factor and an index like the S&P.
Well, one thing that's been standing out to me recently has just been the back and forth on things like software and semis. One day the market's back to the moon, we all are going to buy semiconductor stocks forever, and then a day like today happens and the index is back down almost 6%. How should investors be thinking about this volatility on an industry by industry basis?
Well, ostensibly when you have higher dispersion, lower correlations, equal weight outperforming, cap weighted, Russell 2000 handily outperforming the S&P, you would think of it as a stock picker's market, as a playing field that is more leveled for active management versus passive management. But it also sends a message that it's a trading oriented market, which in fact it is. But for individual investors, I'd say be mindful of not trying to trade, meaning anticipate some of these really short-term moves. There's so much short attention span money in the market right now. And to your point, Bailey, narratives can change on a dime. And you have another example would be communication services down almost 8% in the month of June, up almost 3% today. Trying to gauge when you hit those day-to-day or intraday inflection points, I think is really, really tricky, which is, as much as it's kind of boring to talk about, reinforces the notion of diversification and then maybe more frequent rebalancing in order to take advantage of some of these big swings so that you're taking profits when profits are given to you.
Well, you make an interesting point because, again, starting of the second half, you had yesterday ending the quarter, ending the half, ending the month. How much of this is window dressing in terms of these kind of volatile one-off moves? Is it partly because there's thinner liquidity, or is it still people trying to chase the next narrative or those shifts that are evolving here in the U.S., or particularly as it relates to memory stocks, what's been coming out of Asia?
I think it's a bit of both, but there's always a lot of window dressing when you're talking about the final week of a calendar quarter, because that's when the traditional fund complex, for the most part, does their rebalancing. So it's hard to separate what portion of what we're seeing from a rotation standpoint is driven by that window dressing and what's driven by just the market forces that are in play right now and the powerful cohorts outside of that traditional fund complex, like the commodity trading advisors and the systematics and the long-short hedge fund community, and then the retail trader cohort, which has become a sort of a power horse for the market in and of itself.
Yeah, absolutely. And we've certainly felt the influence of that retail cohort. I want to talk a little bit about, Fed policy here, because we did hear from Fed Chairman Kevin Warsh speaking in Portugal today. And I'd love to hear your thoughts on basically Warsh saying that inflation risks are down, of course, still committing to price stability here. And then you take a look at the market, still not ruling out the possibility that we're going to see an interest rate rise from here. Would love to hear, first of all, just your thoughts on that, and also how that sort of makes its way into the equity market. Because, again, you think about the outperformance that we're seeing from small caps, for example. I wonder whether or not that can sustain actually an increase in rates from here.
Let me answer the second part of the question first, Katie. That's an interesting one. I think the initial surge in small caps was on the basis of easier monetary policy on the part of the Fed. Obviously, that is not the narrative right now, and that may be part of the reason why within the Russell 2000, you've seen a catch-up on the part of the profitable stocks within the Russell relative to the unprofitable stocks. I think it was that unprofitable zombie-type cohort that, for obvious reasons, tends to benefit when you're an easier monetary policy backdrop. That is not the case right now. I think what was interesting about Warsh's comments is he almost provided a little bit for everybody, gave a little bit of the handout to the doves by saying you've seen some ebbing inflation risk. He for the most part, focused on inflation expectations, but at the same time, he wanted to reinforce those sort of hawkish credentials that for many, he established with the June FOMC meeting by saying we are still we're still vowing to get inflation back down to the 2% target. And I think, you're going to see some movement in terms of expectations for whether the Fed hikes in July or not. But even though Warsh is using adaptive as a word right now, I think the bottom line is the Fed and its reaction function is still very data dependent. The next big one, of course, comes tomorrow morning.
Yeah, absolutely. Looking forward to that jobs report. Lizanne, really great to spend some time with you. That is Lizanne Sonders. She is Chief Investment Strategist over at Charles Schwab. Now, coming up, the IPO market kicking off the second half of the year with a strong start following that SpaceX IPO. We discuss with Ted Smith, president and co-founder at Union Square Advisors.
And moving from a hot IPO market to expectations of hot June jobs report out tomorrow. A full breakdown of what to expect with Dana Peterson of the Conference Board.
And from paychecks to playtime, a discussion on the child entertainment economy with an American classic. The Chuck E. Cheese CEO has big plans for a big expansion. All of that and more coming up. This is The Close on Bloomberg.
Meta is taking its AI efforts to the cloud. The company announcing plans for a cloud infrastructure business that will sell access to AI computing power and models, a path to competing with the likes of Amazon Web Services, Microsoft's Azure, and Google Cloud. People familiar with the matter tell Bloomberg. Well, joining us live is one of the reporters behind that big market-moving scoop, Kurt Wagner of Bloomberg News. Kurt, just want to start with, is this a shift for these companies? Are we going to start seeing CapEx be dialed back from the likes of a Meta and instead them selling out some of this excess capacity?
You know, I see this less as a, an immediate, oh my gosh, we've over purchased or we've overbuilt, and more of a future hedge against what they're doing. So Mark Zuckerberg has been pretty open that his strategy is to hoard as much computing capacity as possible. You know, just get all of it that they can and figure out what to do with it later. Well, the issue there, of course, is if 2, 3, 4 years from now, they look up and say, oh my gosh, we have too much of this, what do we do? If they don't have a cloud business already established or set up, it's not really like they have a lot of options. So I think this is as much a hedge for the future than it is a warning sign of things sort of in the immediate goings on.
And it's interesting. So theoretically, this would put them in competition with the likes of AWS from Amazon, of course, Microsoft Azure, Google Cloud, et cetera. You take a look at Meta shares, I mean, absolutely flying today. But then you take a look at those three as well, Amazon, Microsoft, and Alphabet. Shares also higher. So, I mean, what are people making of that? Is this not necessarily seen as a big threat potentially to those businesses?
Well, clearly people aren't taking it as a huge threat to the big incumbents, but we are seeing it as a threat to some of the so-called neo-clouds. I believe CoreWeave was down pretty considerably. For example, I know a lot of the chip makers were down. So those who are worried that this maybe is a signal that, you know, people are going to start building fewer data centers or that we've reached some type of peak when it comes to compute capacity, I think there are fears there. So it is interesting to see sort of who wins and who loses in this mix. I do think that some of the smaller players here, where Meta is now going to be a direct competitor, obviously they stand to lose some, and I think that's being reflected in the stock price.
Yeah, Kurt, I do want to come back to the impacts on the Nebulouses and the CoreWeaves of the world. As you mentioned, down double digits. This seems to be at least part of the bear thesis playing out for those companies, just given kind of the fact that the whole pitch was, well, we have access to this and we're able to sell it to an OpenAI and a Meta. But if this is reversed, what does that actually mean for kind of the longer term when you get to 2032 and beyond?
Yeah, I mean, I think you're right. This is sort of, at least at the initial on its surface, kind of like the worst case scenario for a company like a CoreWeave, where suddenly you have yet another player in the space, one with very deep pockets, one with a lot of experience building and managing data centers. You know, Meta is not like starting at zero here. They have dozens of data centers already built around the world. They have many more that are already in development, right? So I think that this is something, if you are wondering, you know, why is Meta doing this? I think there's a bunch of reasons, but one of them is they can afford to do it in a lot of ways. And so if they see the opportunity, they see all these other big tech companies that we mentioned making tens of billions of dollars in revenue a quarter on cloud business, and they say, well, hey, we already have some of these data centers and we can afford to build more of them. You know, they probably feel like they're missing out a little bit, and this may be a chance for them to try and catch up there.
And Kurt, before we let you go, you know, you report that Meta, they're developing these plans. Do you have any sense of what time frame we could actually see this come to life?
I don't have a timeline for you. Obviously, everything that Meta does and everything Mark Zuckerberg does tends to be as fast as humanly possible. So I would imagine that, you know, if we're starting to hear about this, if people in the industry are starting to hear about these plans, it means that, you know, things are underway and they're moving forward on it. I wish I could give you a more definitive timeline, but I would just say that I imagine that they're working quickly.
All right, Kurt. Well, a fantastic scoop coming from the Bloomberg team. That is Kurt Wagner of Bloomberg News. Now, coming up, software stocks struggling year to date. We're going to get the second half download with Brent Thill of Jefferies when we return. This is The Close on Bloomberg. It's time now for our top calls to look at some of the big movers on the back of analyst recommendations. And first up, Citi clearing Lockheed Martin for takeoff with an upgrade to buy from neutral. They say that the company's track record of bouncing back, quote, consistently and sharply speaks for itself, even as defense stocks experience one of modern history's worst quarterly declines. Price target raised to $582 from 571, shares higher by about 2%. Next in line, love is in the air, with Morgan Stanley upgrading dating app Grindr to overweight from equal weight. The firm seeing real potential in the rollout of an ultra premium subscription tier that could see users paying upwards of $500 a month, and in its telehealth service called Woodwork. Price target up $3 to $18. Shares of Grindr higher by 9%. And finally, we have Salesforce, Guggenheim injecting fresh confidence into the company and the broader sector with an upgrade to buy from neutral. The analyst saying that valuations for software stocks broadly are too depressed. And while the AI threat is real, it's not necessarily the sector's death knell that some think it is, adding that he believes software is, quote, one of the best opportunities for patient investors. Shares of Salesforce higher by about 4.4%, and those are some of our top calls. Meanwhile, let's bring in another analyst here who covers the software space to discuss what he's seeing in terms of AI risk. His name is Brent Thill. He is the tech sector leader of software and internet research over at Jefferies. Brent, great to have you with us. So just talk us through the landscape right now. We know it's been a very volatile first half for a lot of these software names. And the big existential fear is that you have these AI native companies going to come in and disrupt the business and the cash flows of a lot of these software names. Where do you think we are on that story now?
The sucking sound of all this AI investment is so great that right now it's all about AI infrastructure. And so when you look at Salesforce or Microsoft, you have, low to mid-teen growth, but you have 35% growth in AMD, you have explosive growth in utilities, you have a shortage in actual physical infrastructure to move the earth around to get ready for the data center infrastructure. So I think software still looks relatively interesting, but right now there's just a better story going on in broader AI, and that's in infrastructure. So we don't believe the death of software is here. We do not believe there's just going to be one operating system, that being Anthropic. We don't believe that the margins of the software industry are going to zero. It's just right now it's really hard to defend a group when there's so much excitement going on in energy, infrastructure, physical, turbines and machinery and everything else. You look at every other name that's outperforming, everyone's asking, what's the next catalyst for software? And there's like kind of multiple walls of worry you have to get through, right? The industry's in decline, the margin structure's in decline. So it's just, it's a hard group to defend other than valuation in the face of what's going on when you look at the rest of areas you can invest in.
Well, that's what I was wondering, Brent. I mean, you make a really interesting point that you think about sort of investor attention at this moment. It's focused elsewhere. It's not necessarily looking at software, but could you see a scenario where valuations get to the point, get depressed enough that causes investors to maybe take a second look?
Yeah, I mean, valuations are at a place we haven't seen. So if you're valuation sensitive, you look at it and you say, this is go time for software. But what happens is when you have the next model from Anthropic, OpenAI, or you have the next hire from OpenAI, Anthropic, we see a massive downward draft. So all year we've been fighting this narrative. But if you look at semis are up 70 and software's down over 10% year to date. And so I think, yes, is there a point where money comes back to software? Yes. When is that point? We still think you're going to have big CapEx numbers. Remember, software and CapEx are not friends. They hate each other. They're when you're spending the money that Amazon, Microsoft, and Google is spending, software has a hard time working because the money's flowing out of the industry into other names like memory, infrastructure, hardware, And so it's hard to see that narrative changing in 2026. And maybe it changes in 27. But yeah, everything's cheap. But again, it depends on your duration. Is software going to bounce back in the next 3 years? 100%. Are we going to bounce in the next year? I think there's better investment ideas other places based on what we're seeing.
Brent, are you getting engagement with clients? Like, is your phone ringing where clients want to talk about Salesforce? They want to talk about some of the companies you cover? Or is everyone's phone ringing off the hook that, as to your point, is in maybe industrials or in energy or chip makers?
Yeah, it's a great question. We're really busy, but I'd say, like, if you put our energy semi analysts up against me, they would crush me in terms of their schedules, right? So yeah, we're getting a lot of inbounds. Like today, a lot of attention towards Meta moving into the cloud world took a lot of, there's a lot of attention. So yeah, we're busy, but again, I think relatively speaking, the excitement and the energy that's going on in other subsectors. I mean, we have tech analysts who have never spent time on energy and are spending 30% of their time on energy, right? And so I'm naturally getting less time because of that. So I'd say, look, are these bullish signals for software given how the time spent, the negativity, the Brent, your job's at risk? I mean, it's been so negative, it's almost bullish, right? But I just say right now, I think, again, I can't deny what's going on with the relative trade of other names that are just, again, not much more exciting.
Well, Brent, very quickly, in about 20 seconds, when we do get the next quarterly report from some of these mega cap companies like Meta, are we going to see kind of right sizing of CapEx expectations now that we're halfway through the year? No?
No. Yeah. I mean, Meta jumping into the cloud market to us suggests they have to spend more, not less, that they won't pull back. All of a sudden, everyone's like, hey, the market's shifted and this is a pullback moment for the rest of infrastructure. I think that's wrong. I think we learned from Google. Google required a lot of time and energy to get this right. So if they really want to move into this in a big way, not dip their toe in, but do a full cannonball, they're going to require more, not less capital.
All right, Brent, that's a good place to leave it. Great to get some time with you. That is Brent Thill over at Jefferies. Meanwhile, coming up, we're going to take a look at SpaceX's launch into public markets, really made history in the first half of the year. We're going to take a look at the IPO market in the next 6 months with Ted Smith of Union Square Advisors. This is The Close on Bloomberg. Just about 3:30 p.m. in New York. This is the countdown to the close. I'm Katie Greifeld.
And I'm Bailey Lipschultz. Katie, an interesting start to the quarter, second half of the year. Not much going on at the index level, but under the surface, some activity.
Yeah, absolutely, especially when it comes to the IPO market, which is where you live.
Near and dear to my heart, Bending Spoons, the parent company and owner of AOL, Vimeo, a number of other portfolio companies, absolutely ripping today, up about 29% from the IPO price. Katie, this is a deal that priced above the marketed range, which surprised pretty much everyone I talked to on the buy side. And at least day one, here we are, a number of hours into trading, about $25 billion market cap.
And this is a company that I had to ask you what exactly they do. The name itself does not give anything away. You described that they just sort of serially buy companies.
They buy companies. They own Evernote. They own Rimini. They basically buy, having talked to the CEO a little while ago, they basically buy and right-size operations, kind of streamlining the top and bottom line and also kind of trimming the fat to an extent.
Absolutely. Well, Bending Spoons, the market welcoming that IPO with open arms. And let's talk about what the reception could look like for some of the other pipeline candidates over the next 6 months with Ted Smith. He is president and co-founder over at Union Square Advisors, joining us in studio. Ted, it's great to see you.
You too, Katie. Thanks for having me back. Bayless.
So we have SpaceX out of the way, and it seemed like by all measures that went pretty smoothly when you think about that trading debut. Talk to us about the next 6 months, because we have a lot of IPO type conversations on this show, and it seems like it's off to the races here is typically what we hear. Is there any nuance that you would add?
I think the one nuance that could be talked about is what's the regulatory backlog going to be? Because when we went through the government shutdown late last year, that put a lot of folks sort of in the holding pattern. And right now, by our estimate, there's almost 1,000 companies that are in that backlog. So how fast the SEC can get through the paperwork, that's a bit of an unknown. I presume some of the companies that are the headline names may get fast-tracked a little bit, but not everybody will. So it's going to take a little longer, I think, to work through that backlog. I think we're going to hear an awful lot now about the fact that Anthropic is very likely to be next out, and OpenAI may delay till 2027 by all bets at this point.
Yeah.
So it's going to be a lot about Anthropic, and then it's going to be a lot about the other both AI majors as well as AI-infused software companies that we're going to see, I think.
Well, you led us exactly where I wanted to go, and that is that OpenAI delay, of course. That is something that Billy has spent a lot of time reporting on. What did you make of it? Is this really idiosyncratic to the company themselves, what they're working through when it comes to their actual business, or is there anything that we should extrapolate out from that?
I think we learned two things. I think we learned that when Sarah Fryer says, I don't think we're ready to go public, you should listen to her. And when you have Sam saying it's $1 trillion or bust from a valuation perspective, he's willing to wait. So I think that's a combination of they need to get their internal house in order to be ready, and nobody knows that better than Sarah. And Sam does not want to come out and be anything less than $1 trillion company, and so he's willing to hang out until he thinks he can be assured of that.
Well, I thought it was interesting that some of the reporting suggested they were pointing to weakness in SpaceX. It was still up like 20% in market conditions, which, I don't know, having covered the industry for a number of years, it's kind of hard to say 5 months from now the market is not going to be as receptive to your company. How are you thinking about receptivity as it relates to an Anthropic potentially in the fall, and kind of what that path could look like?
I think Anthropic is going to do very well as a public company, and I think it's going to be a great IPO. I think the one thing that we didn't really or haven't really learned yet was the SpaceX strategy of dramatically expanding the retail investor base. How has that worked? Has that contributed to the rapid updraft and then just as rapidly the downdraft? To your point, Katie, it's on a IPO price to today basis, it's trading very well. But if you were one of the retail investors who decided to buy on the way up and got it at 225, you may not be so inclined to participate in those new IPOs.
Well, do you get the sense that there's enough capacity from retail to, divide another 30%, 20% of an IPO for an Anthropic where it's tens of billions of dollars just after a few months after SpaceX? Or do you think there will be some type of kind of tapping out of retail?
I think for the next one or the next few, there's plenty of retail demand that's out there. The question is, can we get through the list of the 20 or 30 or so tech names that may come in the next 12 months?
Well, thinking about kind of the broader backlog, is this a market where you have to have some type of AI story to get real investor receptivity, or can you take kind of a regular way software company public?
I think it's going to be tough. I was listening to the prior segment with my friend Brent Thill, and I agree. It's a tough story in just pure software right now. We will see some software names over the course of the next 12 months, but you do have to have an AI story.
Yeah, it's really funny, how much just psychology informs what we're talking about, that you have a very shiny object over here. It's going to be hard to sort of tear those eyes away to look at this object over here. But I do want to talk a little bit more about the rest of the pipeline, because, okay, I could see how it would be tough for a software company in this AI world to sort of win that attention over. What about for those companies in the pipeline, in that backlog, who are totally outside of the world of tech? Maybe they actually physically produce real products. I mean, what sort of chance do they stand in a market like this one?
I think they can still get out. I think what we learned through SpaceX and and Bending Spoons and some of the other IPOs that have already happened this year is there is appetite. Right now, I focus on tech. That's what everybody wants to talk about, the shiny object. But I think what we've learned is there's capital to go around for new stories that have good fundamentals. You have to have growth, you have to have profitability, and you have to be of a certain size. Right? We don't often see the smaller IPOs anymore the way we used to when I first started in this business. So they're going to be larger companies and they're going to be bigger raises, but they're not all going to be $75 billion at a pop.
Well, that's been the interesting thing, has just been kind of the scale. And scale obviously matters when you talk to investors. And I've even had a few basically say, we don't want to participate in small cap IPOs anymore because we want that exposure when they're private. If a company's going public and it's small, in their view, the upside isn't quite there. If you're talking to a prospective client who's a smaller company and wants to IPO, what's the pitch?
The pitch for them is that for venture-backed companies, still more than 98% of the companies who get an exit get it through M&A, which is why my firm focuses on M&A. So there are the 2% that can squeak through the door, but it's very unlikely that they're going to get to the scale. And frankly, it's for some individuals, it's still a bell they want to ring. But for a lot of folks, recognizing that the likely liquidity event is M&A driven and not IPO driven, that's what they're focused on, building a great company.
Well, how are companies thinking about sales? If I'm in the software space and I want to go out and acquire a private company, I'm probably saying, I don't know what 3 years looks like. I actually don't want to pay a premium to what you're expecting. How are those dialogues kind of playing out in the M&A perspective?
Right. So we have a lot of conversations about doing our best or helping our clients do their best and put their best foot forward with respect to what they think the next year or 2 or 3 will look like. But you're right, there's a lot of unknown, particularly given what AI could do to the software sector. So that's causing longer diligence cycles. It's taking a lot longer to get M&A deals done right now.
Yeah, it's going to be interesting to see how M&A plays out in 2026 and how those IPOs play out. Obviously, all eyes on Anthropic. Our thanks to Ted Smith, president and co-founder over at Union Square Advisors. Well, coming up, investors running to Nike in today's session despite a cautious outlook and a warning about weakness in the latest quarterly report. It's today's Stock of the Hour. Up next, this is The Close on Bloomberg. Time now for our Stock of the Hour. Shares of Nike moving higher despite executives giving a cautious outlook and warning about elevated consumer anxiety in its latest earnings results. Here to break it all down for us from the Wall Street side of things is Simeon Siegel, Senior Managing Director and Senior Analyst of Retail and E-commerce over at Guggenheim Partners. Simeon, just want to look at this stock chart, down 42% in the last 12 months. Is this bottom feeding? Is this short covering? Why are investors bidding up Nike today?
A lot of descriptions. Good to see you. So listen, I think that this is still Nike, and people are trying to figure out exactly your point. Is it bottom feeding or is it earnings stabilization? And I think very simply, we have watched earnings come down frequently and with severity in the last several reports. This quarter, it was a little bit more muted. And so I think if people start feeling like the earnings start stabilizing, we need to see stabilization before we see growth. I think that's what you're seeing people come to right now.
Well, Simeon, something that we were talking about heading into the print last night was just that expectations for Nike are really, really low, or at least they were, this time yesterday. It sounds like what you're saying is that we haven't necessarily reached that inflection point, that maybe this was, a better than feared sort of report altogether.
Hey, Katie, yeah, listen, they're still really, really low. So that still, I think, is a fair assessment. I think, like, if we think about where Nike is versus it's up 3% today, that's a long way off from where it was. So I think people still have fears, people still have concerns, and frankly, the company is acknowledging them too. And so I think right now, the question becomes, do you see is there a light at the end of the tunnel, even if that tunnel is really, really long? And so I think that's the question. And I think people still have a lot of fears that A, numbers are coming down, and B, stock's not cheap, right? From a multiple perspective, you can create fear. I think after tonight, maybe the question becomes, okay, is it just that the stock is not cheap rather than is there still a meaningful reset on the numbers ahead?
And what's the view right now of Elliott Hill?
Listen, it's a great question. I think in general, people, these are big businesses. And I think Elliott came in knowing how to reestablish relationships with the partners, and they're doing that, right? The biggest issue was they had gone direct away from wholesale, left the partners that made them who they are. And he's obviously re-embraced that. I think the stock will tell you in general how people feel about the company. And so I think Elliott would tell you this is harder, longer than he thought it would be, but he still feels the fuel. He still believes that everything is going to move in that direction. And I would say the stuff we were talking about before of can we see the stabilization, that's obviously under his tenure. We'll have a new CFO. And so that'll be worth watching and figure out, okay, what does that change? How much of this has been operational? If you are shifting your channel, if you focused on where you're selling instead of what you're selling, there's an element there where the CFO will have a very strong role. So I think that is yet to be determined. But yeah, I mean, clearly the next chapter hasn't been written yet on this topic.
Well, it's interesting, Simeon. So you think about Elliott Hill. He joined in October 2024. So we're approaching that 2-year mark. And the contours of the turnaround that they would like to execute over at Nike, they're well articulated at this point. It's clear what they need to do. You take a look at shares, there seems to be skepticism there. And we were talking to a guest yesterday who made the point that, maybe Elliott Hill has maybe a year or two left of runway before, the market really takes it away. I wonder if you agree with that.
Listen, I hope you and I have a year or two left. A year or two is a long time. Like, I think the reality is a lot of things can change, but I think stocks are powerful indicators. I think seeing the stock go down be very hard to contest or argue that people have been very happy with how Nike has performed in the last few years, and his tenure is included in that. I would say there is an interesting dynamic, and this is a little bit dangerous because it's going to sound really bullish, and I don't know if we're at the really bullish stage yet, but we do have to acknowledge that if you were to bear hug this business, if you were to start this business, you wouldn't turn the light on everything at once. You would triage it. You would say North America is the most important region. I need to take care of that first. Then I'll probably focus on China. Right. Then I'd probably focus on Europe. And then maybe after that, I'd make my way to Converse. It's just order of importance. And so what that naturally means is even if it works, what it's going to look like is a house on fire falling dominoes. Every time you get one in favor in order, the next one goes. Whereas if we were to actually assess what's happened, North America was never going to grow, and it's already grown.
All right, Simeon, unfortunately, we have to leave it there. Great to get some context with you. That is Simeon Siegel, Senior Managing Director over at Guggenheim. This is The Close.
These rapid fire rotations, I mean, we've seen a blowout on the upside in terms of dispersion, a blowout on the downside in terms of correlation. And that's happening not just broadly across the market, but within sectors and within industries. And I think that kind of backdrop where you continue to get a grind higher, but you really have to look under the surface to get a fuller story of what's happening given this massive rotation.
And that was Liz-Ann Sonders. She's Chief Investment Strategist over at Charles Schwab, helping us to kick off the close on this first trading day of July, a month that typically is pretty kind to the stock market.
Typically pretty kind, but you were pointing out the expectation, or I guess the performance that we saw last quarter, which was pretty robust. But looking at today's move, you know, down 6 points on the S&P 500, pretty darn snoozily. But semiconductors really weighing there, down more than 5%, Katie. And that's in part due to the big news from Meta Platform, Zuck.
Yeah, that was really interesting. Basically, you think about Meta and their ambitions here to maybe enter the cloud business, start up a cloud business to sell AI computing power, really rocketing the shares higher, sort of cast their big CapEx spending in a different light.
Different light, and really kind of begs the question too, are we overbuilding for semis just yet? Maybe, maybe not, Katie.
It's a lot of big existential questions out there. Let's make sense of some of them with Julie Biel. She is portfolio manager and senior research analyst over at Kayne Anderson Rudnick. Julie, great to have you with us. Just to start broad here, I mean, you think about the quarter that we just closed the books on, the S&P 500 posting its best quarterly performance since 2020. When you think about all the different cross currents in this market, do the fundamentals match the numbers here?
It's interesting. I would say broadly, yes. The fundamentals do match the numbers to the extent that we are seeing solid growth. It is starting to really broaden out beyond the dependency we had on the hyperscalers. And for sure, the demand for semiconductors in the here and now is incredibly robust. They're getting the pricing. They're building out for volume. The question is, I think that on everyone's mind is how sustainable are some of these developments? Can we rely on this earnings growth for the long term? I think as we get more breadth in earnings growth, particularly on the small cap side, I think that's going to give people more confidence that this is a market that's not just dependent on a single theme. I think the volatility we're seeing is that we are really tied to one theme.
Yeah, you know, we were just talking about this with Brent Thill, that you think about the problem for software stocks right now is basically the fact that investor attention is elsewhere. It's mono-focused on this single theme, as you articulate as well. So what sort of broadens that interest? You are seeing pockets of outperformance outside of big tech, but what sort of gets investors to maybe broaden their aperture a little bit?
Well, I think some investors are looking for a little bit more of stability. They want a ballast in their portfolio to diversify. And I think that good opportunities exist in higher quality businesses where you have some reliability, some durability to the company's earnings. And that way you are not quite so exposed, because if you're just passively investing right now, you have indices that are what, 20% semiconductors? That's been unheard of for a very long time. And I think people may underestimate the risks of that, because typically we've been told, you know, investing passively is the best you can do. So I think it's really important for people to be able to recognize the exposures that they have and try to find opportunities to add more durability to earnings in case this theme plays out differently than we expect. Just like every other technology transition, it's rarely the early winners that are the long-term gainers.
Yeah, but Julie, just wondering how frothy this market is getting away from tech. I look at shares of Caterpillar up 155% in the last 12 months. It's kind of pretty much neck and neck with Nvidia, depending on how you look at it in the longer term scale. Investors are chasing energy, they're chasing industrials. Which areas are actually relatively cheaper? Can you believe in the kind of longer term and medium term earnings expectations?
Well, I mean, I think one of the cheapest sectors is one of the most unloved is healthcare, and it continues to be unloved. And I think broadly, the space should be unloved because it has a lot of themes that make it unstable. We don't really know how the FDA is going to continue to approve. It's a tricky environment for biotech. So I understand that a lot of healthcare is pretty unattractive, but I think that there are pockets. We own a company, West Pharmaceutical, that just does the elastomers for any kind of injectable drug. You're not dependent on any one drug being approved. They serve all of them. So those types of businesses, these kind of steady, reliable businesses that are not dependent on a single theme or a single company to drive their fortunes, that to me is a better bet than a company that is solely fixated on data center build out, because I don't think we really understand the size and scale and how long it's going to continue for.
Well, how are you filtering for companies like West? Just pulling it up on the terminal, it's a $26 billion company, doing pretty darn well in the last 12 months, this year alone as well. But kind of how are you finding these opportunities, picking through areas that you think maybe are more insulated than kind of everything around AI?
I think one of the things that we really try to screen for is thinking about the returns on equity, the durability of the competitive protections, and also how variable are earnings for each individual company. It tells us how they do through any economic cycle, because what we would like to do is own companies for a decade or more. There are companies we've owned here for 2 decades, and that's the home run for us, right? We know the company really well, and that enables us to really build strong long-term positions in these companies. It's difficult finding them, really, if you focus solely on the quantitative factors. The qualitative factors, what actually protects the business qualitatively, that's harder to discern. That takes more time. It's why our research process is a little slow, at times aggravatingly so. But for longer-term investors, those who can have a longer-term perspective, being thoughtful about that allows you to trade less and know your companies better.
And Julie, we have about a minute left with you, but I just want to get your broad thoughts on supply and demand in this market, because you think about net equity supply in the U.S., it's been going down for the past number of years. It's different in 2026, and you take a look at U.S. IPOs and share sales totaling more than $250 billion through the first half. How are you sort of thinking about that shifting dynamic?
Yeah, I think that so much of what has actually helped this market stay resilient with geopolitical risk and all of the issues with tariffs and even the pandemic is that the supply of equity, good equity, is just pretty limited. And I think that that's created, this liquidity flush that had to hunt for places anywhere really. And I think that now we're really getting this influx of supply that's meaningful. And to me, it almost looks a little competitive in terms of how these companies are going to come to market. You guys were talking earlier about this rush of OpenAI and Anthropic. Who's going to make it first? I think it really matters who's going to come first, because the ability to soak up some of that excess supply is going to be pretty important. Right. I think that's kind of why Google decided to raise equity. I have this suspicion that that was more competitive than about really raising any kind of financing that they need.
Right. All right, Julie, really appreciate your time. That is Julie Biel. She is portfolio manager and senior research analyst over at Kayne Anderson Rudnick. As we count down to the close, a global simulcast starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Bailey Lipschultz. He's in for Romaine Bostick. Here to help take us through the closing bell, we're joined by a global simulcast. Carol Massar and Tim Stanovic. We bring together all of our various audiences to talk about the first trading day of July. Carol Massar, a month which is pretty good for the equity bulls, but a little bit of a sell-off into the close.
Yeah, absolutely. But I got to say, not a great start to the third quarter or the second half for semiconductors. The Philadelphia Stock Exchange Semiconductor Index, the SOX, it is down about 6.2% as we speak. So we're seeing, once again, it's been a volatile sector, I feel like, as of late, but you're seeing some intense selling today.
Did you see this news from Mark Gurman and Maggie Eastland that Apple is looking to buy Chinese-made memory chips with this lobbying push.
Wow.
Micron shares were down. They actually reached session lows after this story was published. Micron shares down just heading into the close, down about 10% right now. Apple shares spiked higher, up about 1.5%.
Yeah, Tim, it's been a tough, as Carol mentioned, tough go for some of these chip-making companies. Again, the rotation, they're up, they're down, they're up, they're down. Adding to that negative sentiment is the potential for cross-selling and competition from China.
Yeah, absolutely. It's going to be interesting to see how the overall tech trade develops in the second quarter when it comes to chips, when it comes specifically to memory chips, when it comes to software, of course, which has been, sort of the poster child of investor distaste over the past several months. But at least for today, we wrap up the first trading day of July, of the quarter, of the month. The S&P 500 looks like it's going to finish about 0.2% lower here. The NASDAQ, a little bit more selling pressure when it comes to some of those tech names. The NASDAQ Composite down about 0.6%. The Dow Jones pretty much flat on the day. Do with that what you will. But then we take a look at the small caps, for example, not escaping the selling pressure either, because it looks like, Carol, the Russell 2000 going to finish just a little bit lower on the day as well.
All right, so that's a look, the big picture there from Katie. I'm going to go back to the S&P 500. And Bailey, you've got 299 names in the S&P 500, higher here at the close, about 204 to the downside, one unchanged.
Yeah, and we're looking a little bit under the hood on a sector-by-sector basis. Seeing some strength for communication services and financials as well as consumer discretionary, but the big drags, information technology, and then also seeing some weakness across utilities and industrial. So an interesting bifurcated market.
All right, guys, let's get to some individual gainers, if I may. And I'm looking at the number 3 gainer in the S&P 500 today, and it's the number 2 gainer in the NASDAQ 100. We are talking about Meta Platforms. This one, at its highs intraday, up about 11.5%, settling down, though, with just under a 9% gain in the session. This has the companies developing plans for a cloud infrastructure business to sell access to AI computing power and models, competing with industry leaders such as Amazon Web Services and Google Cloud. So really leaning into the hyperscaler mode, if you will. Company considering selling access to various AI models hosted on its existing AI infrastructure, as well as raw computing capacity as part of its Meta Compute initiative. Some of this has to be as a result of the pressure on the company to basically justify all of the spend that it has done on building out some of their data centers. So now maybe kind of renting out, if you will, its excess capacity. So an interesting one on this. We talked with our Mandeep Singh of Bloomberg Intelligence. He's like, is this a temporary thing? Is this something more substantial? So we'll look for some more clarity from the company on that one. Over to another Mag 7 I go. Got to talk about Microsoft coming off its worst month in years due to concerns about how the company will fare in a world marked by AI. The stock was down 17% in the month of June, bouncing back a little bit here on the first trading day of July, up about 3% in today's session. Microsoft planning to announce thousands of layoffs as the company aims to increase spending on AI. Tech giant is expected to cut less than 2.5% of its overall workforce of about 220,000 people. This is according to people familiar with the matter. This was coming from Business Insider. They reported this late yesterday, so the stock bouncing back today. And then, Bailey, you were like, you're all over the place. You were on air with us in the 2 o'clock hour. We caught up with one of the co-founders of one of the IPOs today, Bending Spoons, an IPO at the close, up about 40% in its first day of trading here. And this company, its backers raising about $1.68 billion, market value of, I should pull it up, it was roughly about $21 billion.
26 right now, at least of the close, Carol. So pretty darn big move.
Not too shabby, right? Although I feel like you and me and Tim, we were trying to press this guy, one of the co-founders.
Luca Ferrari?
Luca Ferrari, on what the business model is and kind of where growth comes from going forward. So a lot of questions. I'm already looking forward to its first earnings day.
Yeah, you and I both.
Yeah, exactly.
Bailey had great coverage on the Bloomberg terminal, too. Check out his stories there. Hey, I wanted to get to decliners, and I kind of want to play off of what Carol said about Meta Platforms. CoreWeave shares today falling 14%. So Meta surging by, after our Bloomberg News team reported that they're getting into this new business, but it's CoreWeave's turf, specifically considering selling access to various AI models hosted on its existing AI infrastructure, as well as so-called raw computing capacity. That would be part of its Meta Compute initiative. And that is what CoreWeave does. We also saw Nebius fall double digits today, another neo-cloud provider. Also, check out shares of Caterpillar. Speaking of AI plays, yes, Caterpillar has been an AI play. Down 6.9% just today. Michael Burry, you know him from The Big Short, for his bets against the U.S. housing market ahead of the 2008 financial crisis. He said in a post late on Tuesday on Substack that he shorted Caterpillar shares for the first time. He also shorted NVIDIA, Applied Materials, iShares Semiconductor ETF, Tesla, saying that the stocks itself is a pure form of overvaluation in an index. Okay, Caterpillar shares down today by 6.9%. And finally, let's get into retail. End with Walmart, shares falling today by close to 4%. It closed at its lowest intraday going back to November of 2025, or actually lowest close now since November of 2025. Down for 6 days in a row, the longest string of down days since October 31st. Cleveland Research issued a report that says that quarter date trends have slowed. Separately, Jefferies U.S. consumer strategist wrote that, well, he's unsure if it's the bottom for Walmart shares. He has no idea when new money will step in, given the drop today and the 20% decline from the peak. He said he would not be shocked if Walmart executives are discussing, is there something we should do or say this week or next, given the violence in the move lower, down close to 20% from those June highs.
All right, let's take a quick look at the bond market. We did hear from Fed Chairman Kevin Warsh speaking in Sintra earlier today, saying that inflation risks are down, not making too much of an impact in the market overall. You can see we're talking about basis point moves in either direction. We know we have that big jobs report coming on tomorrow, a rare Thursday jobs report, so maybe lying in wait for that. But I really want to talk about Taylor Swift.
Well, I was going to say, yeah, there's the jobs report. That's important. But you know what's really important?
What?
Is Taylor Swift, are they getting married really at the Garden? I don't know.
I can't believe it.
I feel like...
You do believe it, Kayne?
No, I can't believe it.
I feel like it's a major distraction.
Maybe.
But it's almost too obvious, right?
I don't know. I hope it's a red herring. If it's a red herring, they put a lot of planning, a lot of logistics.
But she's good with this kind of stuff. She is. Like distracting you.
So the New York Times has reported that there's a planned gathering of 100 people at Madison Square Garden on July 2nd, which is tomorrow, followed by a second event for about 1,000 guests on July 3rd. So it hasn't actually been confirmed that this is the wedding.
Wouldn't you just like do maybe a concert or a party and then?
I think she's going to do a concert.
And then maybe get all your guests on some planes or something and bring them to Rhode Island.
Or you'd go to Watch Hill, where she has a beautiful estate up on the hills overlooking the ocean.
Yeah. That's what I'm hoping happens.
Right?
Bailey, what do you think?
I can't believe that she would do it.
I think it's a head fake, but I also want to give Travis some love. I feel like all we do is call it Taylor's wedding. There have to be two people to be part of a wedding.
Bailey, you've been married. Don't you know the wedding is all about the bride?
He's been married and he's currently married.
You are married. Sorry. It's all about the bride.
My first wife is a big fan of me. Okay?
Oh my God. My first
I only
wife.
have one.
My ex-girlfriend, first
current.
wife. Yeah, that's funny. We'll see, though. I mean, it's kind of exciting because we're going to find out in the next few days what exactly is happening here. But it just seems...
I think the best part is, Katie, you want to talk about it, but you're like, I cannot wait to not be in Manhattan to find out.
I know, that's the thing. Getting out of the city is the thing to do. It's funny, actually, New York City Mayor Zohran Mamdani has been asked multiple times about this. He's used those occasions to sidestep the question and just encourage everyone to stay cool during the heat wave as that heat dome descends upon us all.
I'm just going to say she's known for her 4th of July parties.
I know.
So she's kind of like leading up to it.
And you know, again, we're just talking about July 2nd, July 3rd, so maybe the wedding really is on July 4th. Maybe she isn't really getting married at MSG. That would be insane.
All I know is you got to get it done before the next football season starts. When do they start training?
Why would you look at me for
I know. This is not, although you've been all in on soccer.
Ask Bailey.
He's got some time. He's got some time before he's got to report for camp.
Got to do a honeymoon.
Got to get done. Honeymoon, yeah.
All right. Well, I hope you and your first wife are okay. We got to run. That is a wrap on our cross-platform, guys. Radio, TV, YouTube, Bloomberg Originals. We do it all. It is called The Closing Bell. Bailey and Katie, of course, continuing on The Close on television. Tim and I back here on Bloomberg Business Week Daily, on YouTube, on radio, and, of course, on Bloomberg Originals. We will see you. Not me. I'm going to be off. But most of these guys will be here. Same time, same place tomorrow.
And coming up, the AI boom getting a reality check. Rashaan Reid of Bank of America joins us next to discuss. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld. Let's take a look at how markets closed out on the day, the first trading day of July and of the new quarter. The S&P 500 actually falling a little bit on the day. A lot of that pain came from big tech. We know that ran into some trouble, even though July, historically a pretty good month for the S&P 500. But you think about the bond market, pretty quiet as we await for that jobs report tomorrow morning, dropping at 8:30 a.m. A rare Thursday jobs report. There's the board. And then you take a look at Brent crude, also falling a little bit on the day, down by about 2.4%. Let's take a look at some of the individual movers, though, and see what action happened under the hood here. We had Meta, of course, surging in a big way. That was the big story coming, that Meta potentially getting into the cloud business, sending shares higher by about nearly 9%. That was bad news for the likes of CoreWeave, for example, potential threat to their business, shares dropping about 14%. And then one of your big losers on the day was one of this year's big winners, Micron, shares down about 10.6%. Meanwhile, let's get to our top story this hour, sounding the alarm on the AI boom. The IMF's Tobias Adrian warning that AI debt issuance may point to more of a financial stability concern than stock valuations alone, saying, quote, there's a potential maturity mismatch in between the duration of the physical assets and the duration of the debt. Now, those comments add to a growing chorus of caution, with the Bank of International Settlements also flagging the technology as one of the 4 pressure points threatening global prosperity. Rashaan, Reid, co-head of global FICC sales over at Bank of America. She joins us now. Rashaan, great to see you.
Great to see you. Thanks for having me.
Well, I would love to get your thoughts on those comments coming from the IMF, that you think about all of this debt issuance that we're cutting from these tech companies to fuel these AI ambitions. I mean, do you harbor some of those similar concerns when you think about what we're talking about in terms of duration of the assets and the duration of the debt itself?
Yeah, so I think when you think about sort of the AI boom, and it's certainly a boom, but I will say that investors have become increasingly cautious in terms of how they look at the space, and they really are looking at the project itself, thinking about financing, contracted revenues, good sponsors, where there's long-term stability and cash flow. And so I think what we're seeing is that the markets have been open for all the financing that needs to occur, and I think we're going to need to use all the markets, so whether that be credit markets, sort of private markets, as well as securitization markets. We're seeing an evolution of various solutions that can be used to really allow investors to play in the structural theme and tap the markets in various ways. So I do think we have a breadth of financing resources and solutions, and I think investors are being very keen about how they play and looking at some of the things and topics that were mentioned in terms of duration matching, et cetera.
Well, talk to us a little bit about the supply-demand dynamics, because you think about, again, all the debt that's coming to market from, a cohort of companies that really didn't do too much in the way of debt issuance. You think about big tech, it's historically been pretty capital light. That seems to be changing right now. What does that mean potentially for spreads? Could we see spreads widen out a little bit just as the market tries to digest all of these different deals?
Yeah, I think what we're going to see is it's going to be idiosyncratic. I think it's going to matter like who the sponsor and the issuer is. And I think that's healthy for the markets, right? We want to make sure we keep good underwriting standards and differentiation in the market such that it's priced accordingly. But as I mentioned, I think the ability to be able to tap multiple sources within financial markets, particularly within fixed income, and using different forms of financing, inclusive of project finance, et cetera, gives us a little bit more variety and allows spreads to be hopefully a little bit more resilient.
Yeah, well, so far, certainly we've seen that resiliency on display here. And I do want to hear where the investor appetite is right now, because if you think about infrastructure, I mean, that is well articulated as one of the hot spots in the market, though the concerns do exist that perhaps we're in the midst of a fantastic overbuild when you think about all the different projects that are ongoing or set to begin. What are you hearing on that front? What are your conversations with clients and investors sound like?
Yeah, I think in addition to just the AI theme, there's a big macro story at play here. We obviously know we have a new Fed chair in place, and there's been various ways that the market is reading what we may see on a go-forward basis. Our own Bank of America research team just put out a bold call, but backed by really good, strong, solid thought in terms of expectations of 3 hikes, so 75 basis points this year. But there's a debate in the market about that. Some investors feel certainly that we are going higher and we will get a rate hike, and so they're playing that in the short end of the market. Others are a little bit more skeptical and think we may be measured and on hold this year, or just uncertain about the path of rates. And so therefore, when you think about the belly of the U.S. Treasury curve, we've seen some demand there. So we are having a little bit of a dichotomy and conversation in the market in terms of where we're going to land on the forward path of rates. And so that macro picture has become a little bit more front and center. And we're also seeing that play out in FX markets as well, as the market has moved to repricing a hawkish stance. And the FX volatility we've seen in terms of the dollar being back, certainly in FAD. And listen, I think it'll be measured. I don't know that we will continue to see a straight line in terms of a movement up, but it is supportive of a hawkish rate environment in terms of higher rates. And so I do think the dollar now is back in focus, and we're seeing those flows.
Well, let's talk about that a little bit more, because especially you think about some of the ructions that we saw with the yen this week, sort of falling to that 40-year low versus the dollar. I mean, the size and scope is just fantastic here. So, I mean, when you think about FX back in focus, talk to us about the expectations for the dollar. Are you expecting broad dollar strength, or will it really be on a pair-by-pair basis?
I think the pairs are certainly important, particularly when you look at it versus EM markets. I do think the underpinning of a hawkish environment is overall good for dollar-denominated assets. And so therefore, we should see in the near term the dollar being supportive. But I do think even, with the flows that we even saw at the beginning of the week, a little bit of a pullback. People are being measured in how they really play or invest in the FX markets. And so I do think we're also seeing the use of good hedging strategies. And instead of sort of outright large bets, those are happening in some ways. But mostly people are being really cautious and conservative and creative about using option strategies in the FX markets, as well as putting on hedge strategies as well, and so that they can really manage the risk in terms of the volatility we may continue to see instead of a straight line move higher in the dollar on a consistent basis. And by the way, we're seeing that with corporate clients as well.
Right.
We're being very, very cautious, but also very creative about how they're managing their FX risk. But it is in focus. I think the pairs matter. Certainly, to your point around Japan, we saw it in FX, but we also saw it in the rates market in Japan as well. And so we're always watching that in terms of the impact it could have in broader markets and treasury markets.
And before we let you go, I do want to talk a little bit more about duration when it comes specifically to the treasury market, because, you have seen that big demand when it comes to the front end, especially when it comes to cash-like instruments. And it seems like there's this real reticence to even consider going out the curve, especially when you think about really the far foreign places when it comes to sort of long duration assets. What changes that perception? Is that something that you see changing sometime soon?
Yeah, I think it's going to be also what we see out of the Fed, right? I mean, we know they have various tools in addition to potentially hiking rates. I think our new Fed chair has been very vocal about the use of the balance sheet. So I think that's going to be important as well to determine sort of what we're going to get in terms of investment in the long end, et cetera. But right now, I think we're seeing views being expressed on both the short end of the curve in terms of being paid rates for those that think the hike is imminent, and we will get a couple of hikes this year. And in the belly of the curve, we're seeing also some investment from those that are a little bit more cautious on how quickly a hike may happen or just uncertain about rates. But I do think the tools that the Fed uses and has in their toolkits, we have to watch and see. And I think we're going to be getting a little bit less forward guidance. So it'll be interesting to see how it plays out. But it will also make the data that much more important.
Right. Well, we get another big dose of data tomorrow morning with that jobs report. Rashaan, great to get some time with you. That is Rashaan Reid. She is co-head of global FICC sales over at Bank of America. Now, coming up, we keep the conversation going on the AI debt binge. It's fueling the 100-year-old private bond market. That story next. This is The Close on Bloomberg. AI's debt binge is fueling the 100-year-old private bond market, with issuance climbing to around $81 billion from the start of the year through May. That's the most for that period going back to 2016, according to data from Private Placement Monitor. Joining us live is the reporter behind that story. Her name is Emily Grafeo, sitting to my right. Emily, great to see you. So give us the lay of the land here. We're talking about a century-old market. What are the new forces coming into it?
Okay, so we're talking about the private placement market. This is a market where borrowers can source funds directly from institutional investors, and those institutional investors don't trade the debt. It's typically a buy and hold market. You said it. It's been around for over a century. Long before the SEC was even created, Katie, railroads, mining companies, canals needed debt, and they were going to the private placement market to get that. But it's getting a resurgence now because of the massive needs for AI. So we've seen a couple deals in the private placement market that are topping $1 billion, $2 billion, $3 billion of them. $3 billion worth, and a couple of them are for data centers. We saw a chip financing deal.
Right.
Just kind of that need for capital means that this market that's been around for a while is revving up again.
Yeah, and it's interesting to hear you say that this market, you know, it sort of predates the creation of the SEC. So how does that actually work? I mean, how is the SEC sort of interacting with this market today in 2026?
So not to get too technical, but there's an exemption.
Here's the stage to do it.
So there's an exemption 4A2. And basically what it says is that if you want to issue debt in this market in a private placement, you don't have to register with the SEC. And that's because you're just selling the bonds to institutional investors, mostly life insurance companies. So if you're a private company and you want to issue debt, you want investment grade financing because it's mostly investment grade rated in this market, but maybe you don't want your financials spilling out into the open, you can go to this market and keep everything relatively private. You can kind of customize the deals too. So for example, the biggest private placement deal on record that we've seen in the traditional sense was Danaher. $3 billion. They did it all in Swiss francs.
Right.
So they were able to customize for a currency. Sometimes you can get a tenor that maybe you wouldn't be able to get in IG. And that has been really helpful for these AI deals when there's these complex financings.
And so something we talk about in relation to private credit is sort of the illiquidity premium. When we're talking about private placement, is that premium even higher?
Yeah, you typically do see a little bit of a premium above a corporate bond in the private placement market. And again, the insurers like this. They have long dated asset liability match that they need to do. And we've also seen that annuity sales hit a record high last year. So that's helping propel the market too. Just suddenly these insurance companies need to deploy their capital somewhere.
And just quickly here, so as I mentioned, we're talking about the biggest numbers since about 2016 or so. I have to imagine that, you know, folks are expecting these numbers are just going to get bigger and bigger.
Yeah, 81 billion was through May, but again, we've seen individual deal sizes top 2 billion, 3 billion, likely going to be a record year in issuance this year.
All right, well, you're going to have a whole bunch of fun covering it. That is Emily Grafeo of Bloomberg News covering the space for us closely. Now, coming up on The Close, Wall Street bracing for the next big market catalyst in tomorrow's jobs report. Ramp economist Ara Khazarian, as well as Dana Peterson of the Conference Board, they join us next for the latest read on the labor market. This is The Close on Bloomberg. Forget the AI jobs apocalypse. New research from Ramp Economics Lab suggests that companies investing more heavily in AI, they are also hiring more. Ara Khazarian, he is economist over at Ramp. He joins us now. Ara, great to have you with us.
Thank you for having me.
I feel like you're here to do some myth busting because you think about all of the doom and gloom and sort of the worst case predictions about the effect that AI will have on the labor market. It's that it's going to result in job losses broadly here. But your research actually shows something a little bit different.
Yeah, I think if you're a market participant, whether you're a reader of the news or you're a college graduate who's on the job market now, or you're an engineer or a business owner, it's really hard to understand how is AI going to affect our jobs and our economy. So this latest research comes from RAMP, so it's business spend platform, so we get to see the card and bill pay spend of all firms, including their AI spend. We were able to join that with workforce data from Revelio Labs. And here we found the first firm-level data set that shows what happens when firms adopt AI. So a 10% increase in headcount over the following 2 years, including a 12% increase in entry-level headcount. So very great findings, especially if you're trying to understand where the economy is headed going forward.
Yeah, it's interesting. So firms that adopt AI, they grew headcount 10.2% over the 2 years that follow adoption, but the low-intensity adopters saw no statistically significant change. How are you measuring sort of the intensity of adoption?
Well, that was one of the great innovations of this research, is understanding that not every firm that tries AI necessarily sees these kinds of gains. If you employ a ChatGPT subscription across your employee base, you notice that it's kind of nice to have, but it's not necessarily that productivity enhancing. Amongst the high-intensity businesses, we found that they were using particularly more advanced software and services that could include the coding agents or API services, something beyond ChatGPT as a chatbot itself. In addition, there seemed to be some amount of a learning curve before you see the gains, that firms don't typically see the gains of adoption without some sustained use, maybe about 6 to 12 months of adoption before they actually get these headcount gains.
So talk to me about why this makes sense. Why, if you're a company that's really aggressively adopting AI, why does it then make sense that you would also be hiring more people?
That's one of the challenges of understanding where to go next in the research, is that we know that AI must be somewhat productivity enhancing, and that businesses keep investing more and more into that. They must be doing that rationally. And yet the firms that are using AI well have no incentive to publish their playbook and tell other businesses, particularly their competitors, how to grow more quickly. So the focus of our research is understanding, well, first of all, are they seeing headcount gains? And then secondarily, are they hiring different kinds of employees? Now, the first result we have there is this growth in entry-level headcount. It is so outsized at 12% versus 10 that we believe that the firms using AI intensely are now starting to hire a new kind of employee, likely someone more AI native who can employ the tools more productively. And what better place to look than recent grads and folks just coming out of college on the job market who've already been using AI very natively.
Also counterintuitive because, again, you think about some of the existential fears out there is that it's going to sort of replace the need for those entry-level folks, just looking to start their careers. But talk to us a little bit about, what types of companies tend to actually aggressively adopt AI, because you also make the point that when we're talking about these gains, it's pretty unevenly distributed in this labor market.
Exactly. We found in our research that who funded you as a company is a better predictor of your AI adoption than the sector you're in. Tech companies in California are more likely to use AI than tech companies in New York. There's no obvious reason for that, other than the fact that AI adoption tends to proliferate through these networks of both who you know and the kind of labor pool you can hire from. But that is an economically suboptimal outcome. Small businesses, for example, are less likely to use AI in the first place, but when they do, they use it more intensely, and they tend to drive outsized gains from it. So I think the challenge for policymakers, and particularly for businesses, is understanding, well, how can we resolve some of these uneven distributions of AI? Because today, these gains seem to be concentrated around tech companies that are more likely to use the tools in the first place, and for whom the tools were already initially developed. Of course, some of the best commercially advanced forms of AI that are productivity enhancing, coding agents specifically, were targeted for software engineers. So it's an open question whether or not that kind of adoption and that software development will be able to expand into other sectors.
All right, well, it's really fascinating research. It's going to be interesting to see, what else develops here. Really appreciate you making time for us. That is Khazarian. He is economist over at RAMP. Now, sticking with the jobs market, the U.S. June payrolls report is due tomorrow at 8:30 a.m. Eastern. And our next guest noting that the labor market is likely still close to full employment as companies largely remain on the sidelines due to ongoing uncertainties. Dana Peterson, she is chief economist and leader of the Economy, Strategy, and Finance Center over at the Conference Board, joins us now. Dana, great to have you with us. So this lands at a very interesting time when it comes especially to what the market is thinking about in terms of the Federal Reserve's rate path trajectory. So give us the lay of the land here. What are you expecting to see at 8:30 tomorrow?
Well, it's quite possible that we will see a strong number, but again, it's probably going to be very much located in the areas that are experiencing labor shortages, and also areas that are just kind of waking up from the cold winter. So that would include healthcare and social assistance, as well as leisure and hospitality. Leisure and hospitality might also be bolstered by the World Cup being in the United States and lots of people getting hired. But we could also see some seasonality action in education. And when I look at government, it's mainly local governments are hiring people, but we'll probably continue to see consolidation in tech and finance. Like the gentleman before me, he mentioned that, those are the companies that are shedding workers, but hiring workers with different skills. So we probably will continue to see that, as well as federal government cuts.
Yeah, it's interesting. You think about, the different predictions on what AI will mean for the labor market, and it seems like a lot of churn, but drawn out over quite a lengthy timeline here. I do want to talk a little bit about how this moves the needle, if at all, for the Federal Reserve, because we have a new Fed chairman. We've gotten one press conference under our belt. We heard from Kevin Warsh again today, and it seems like this is a Federal Reserve that's much more focused on the inflationary side of things, not necessarily on the labor market. And it doesn't seem clear whether or not, we could get anything or are expecting to get anything that would sort of change that focus for the central bank.
Yes, it is clear that new chair Warsh is primarily focused on price stability. And he said the rest of the committee was as well. There really wasn't much mention of the labor market in his press release, in the FOMC press release, and at least in the press release, his press conference. In the press release, yes, there was mention of the dual mandate. But I think right now there's not really much for the Fed to worry about. The labor market is more or less in balance with respect to supply and demand. There's still uncertainty out there that's causing workers not to quit, and also companies not to lay off people or hire them. And I think that for the most part, the unemployment rate has stayed very low because you don't have this churn. And it's not the case that everyone who's unemployed can't find a new job. It's very sectoral. So I would expect that as long as the labor market does not show any signs of stress, the Fed will continue to focus on inflation. And indeed, Warsh said today that risk to inflation expectations have eased. And it's also our expectation that inflation will start easing again, and that the Fed will not need to do anything in terms of interest rate changes this year.
Right. So the Fed sort of on the sidelines here, employers on the sidelines as well. It feels like we've been in this low hire, low fire sort of labor market for a while now, Dana. And I wonder, in your view, what you think might break us out of that, and what sort of timeline we're talking about when you think about sort of the course of the rest of the year.
Sure. I think the word of the last 2 years has been uncertainty. And certainly last year we had a lot of changes in fiscal policy. We did have some changes in monetary policy, but the bigger issues were things like tariffs, which was kind of a brand new thing, especially on just about every other country. And then, we pretty much, I think, were beyond the tariff shock. But then earlier this year, starting in late February, we had the conflict in the Middle East, which had also had a global impact and really affected what was going on in the economy. And so that level of uncertainty has basically kept a lot of people in stasis, not only workers, not only companies, but also their workers. But again, the inflationary impacts from tariffs are probably already hit a peak that's coming off. And the conflict is not as hot as it was. And so we are anticipating that, certainly we've seen oil prices come back down, not exactly $60 per barrel, but something much closer than 100. And that's going to filter through over time. And we'll see lower inflation, hopefully by the end of this year.
All right, Dana, really great preview of the report we're expecting tomorrow. That is Dana Peterson. She is chief economist and leader of the Economy, Strategy, and Finance Center over at the Conference Board. Meanwhile, let's take a look at how markets closed out on the day on July 1st. The S&P 500 selling off a little bit into the close, down about 0.2%. You can see the hit was much larger when it comes to big tech. The Nasdaq 100 off by about 1.5% on a pretty quiet day for the bond market. 10-year yields rising just about 1 basis point as Brent continued to drop, down about 2.4%. This is the close on Bloomberg. Well, we know that consumer spending has remained resilient in the face of inflation, and part of that is going to experiences such as Chuck E. Cheese. It's a company that has evolved throughout the years and is now fast at work on yet another expansion, this time with its Adventure World playground concept. Romaine Bossick and I, we got a chance to sit down with CEO Scott Drake to talk about what's next for the brand. Take a listen.
We have the blessing and curse of being almost a 50-year-old brand. And we've defined kids. We've defined safe, fun environments for kids. And that's still where we live. You know, we don't kind of get lost with distractions. We are who we are. We like to think we own that space. You know, we're the birthday capital of America and globally in a lot of countries as well. And that's what we focus on. And we're just finding, what do kids and families want and need today? What is of interest to them? What's relevant today? The brand's massively changed. You know, the biggest thing we have is all the change people are unaware of.
Well, talk about what you want to change. You were obviously CFO for a while, and you just recently became CEO. Give me a sense as to exactly what you want to do.
Right. So the beauty of coming in as CFO is they had an amazing team, amazing initiatives that were driving traffic, driving the business. We had a brand that needed refreshing, you know, coming into COVID. And the beauty is our partners invested over $400 million. We have reimagined every store in the U.S. If you haven't been in the last 4 years, you don't know Chuck E. Cheese today. So I got kind of the blessing of CFO of that massive investment, driving traffic. We had a subscription model, you know, 2-month summer fun pass, as well as an annual subscription model, driving lots of traffic. We were the innovators back in 2004. We're continuing to grow that part of the business. Active play, we've got mini bounce pads. We've got a kids obstacle course, Chuck E. Cheese superhero playground. Huge attraction as well, driven a lot of traffic. And on top of that, we came out with value. Our consumer is the lower part of that K-shaped economy. You know, dollars are really, really tight, as we all know, as you talk about every day. We found ways to relate to them. Family fun, clean, safe fun. $99 birthday is a great example. Rolled that out in 2004. We've grown our birthdays almost 40% since then, over 500,000 birthday parties last year at Chuck E. Cheese.
Well, Scott, as you mentioned, you are the birthday capital. You define kids. I wonder, you know, do you try to appeal to adults at all? You think about Dave & Buster's, for example. They have the full bar setup. Is that something that you've looked at, or are you really sticking close to the kids' lane?
Being a parent, I know that when your kids are there, you're there too. And so we do. We have phenomenal Wi-Fi. We have amazing hand-tossed pizza. We make our dough from scratch in every location, you know, proprietary sauce, cheese. So it's a handmade pizza. It's a great food product. We have drinks, beverages. We do have something for those adults. Some of the games as well, you know, the skee ball challenges, some of the basketball and football tosses that go on, you know, for the adults. We like to think we've got something for them as well.
Yeah, and it's funny that you mentioned the pizza, because obviously that took off in an interesting way during the pandemic, so keeping that momentum going. But let's talk a little bit about what the future looks like. You have some new concepts coming out, Adventure World, for example. You mentioned to us before we started that you're on the hunt for real estate. So, you know, talk us through the choreography there, and when you're looking for that real estate, you know, where are you looking?
Right. So what we did was these initiatives I talked about. I got to come in as CFO to a very healthy business with all these drivers. Now that capital investment cycle has ebbed. So we could spend a minimal amount of capital, free cash flow engine, but we opened a very first Chuck E. Cheese Adventure World in the Dallas area. It's an enormous indoor playground, again, for kids and families. The difference is at our active play in store, it's 56 inches and below. It's little kids. This, any size kid, adults can come in with their children. So we can kind of stretch that age group a little bit. But the first unit we opened has far exceeded expectations. So it's this enormous white space potential for the brand. So we're opening them as fast as we can. We need a similar size box, but because there's a 3-story play structure in most of these facilities, it needs a higher ceiling. We don't want to go to warehouse districts. We want to stay in retail areas, so we're on the hunt for those. We should have 6 to 7 more open this calendar year, and then it's going to be about 4 to 6 every quarter after that. We call it test and learn. We've got to learn where it works, where it doesn't work. Everything we're seeing so far is it's exactly what parents want. That active play element, it's our history. It's the ball pits, you know, and the sky tubes, which we haven't had for about 20 years. But we put in mini bounce pads, the obstacle course, huge response to those, and that's why we kept moving into this.
So you're focusing more on retail spaces rather than that. Is that do you need that sort of connection to other types of retailers in order to draw traffic, or can you stand on your own?
You know, it's interesting, Chucky, because we're really an industry of one. Nobody does kids 3 to 9, you know, kind of 2 to 12 like we do. We really own that space, so we are a destination. People will come on average 30, 45 minutes to a Chuck E. Cheese, but we do like being in those busier traffic centers where there's a lot of traffic coming through. It's, hey, let's stop and have some fun for a bit. The kids, you hung with me through, you know, the other stores, let's go have some fun, and we're the place for that.
Do you have the capital for this expansion, or are you going to need to borrow more to do it?
No, we recently refinanced our debt last year, and as I said, now that we're through with the heavy capital, we're free cash flow positive. We can afford to build a lot of these locations, self-fund all of that. We will not be back to borrowing.
Is that going to be expansive, the margins? Your general idea?
Yeah, absolutely, absolutely. These units, they're about half the cost to build of a traditional Chuck E. Cheese, so the return model is outstanding. It's why we're so excited and why literally we got to define the white space. It could literally double, triple the size of the entity within a few years.
And Scott, you know, we've talked a little bit about the competitive landscape, but I also want to talk about, you know, the competition for attention out there, because, you know, you think about Chuck E. Cheese. I mean, certainly it was also the birthday capital when I was growing up as well. We've seen nostalgia plays sort of take over when it comes to retail and apparel as well. But how do you stay relevant? How do you, you know, approach marketing as such to sort of win that attention auction, if you will?
Right. I think it's a couple ways. Like, when you're a 50-year-old brand, part of what we have to do is we're not a new kid to the block. We know change. We know being relevant with the current ages and the current, you know, kind of psyche of the world, and that's what we've done. Our marketing team is phenomenal. Part of that is data, it's insights, it's the AI engines we have on guest satisfaction, what's working in store, what's not, what they like about birthdays, what they don't, and that's how we're able to modify. It's where the $99 birthday came from that drove so much, you know, traffic through the stores, and we'll just keep leveraging that and doing that, you know, staying relevant.
Geographically, though, are you looking into certain areas? I mean, I know you're kind of spread out across a wide variety of states, although you do have a kind of a heavier concentration in like California and Texas.
California, Texas, Florida, the New York area, we're more concentrated. But we're in about 45 states. We're within the major markets of 96% of the population in the U.S. So we're kind of where everyone wants to be. The beauty of our new Adventure World concept we opened is for the first time, normally if we open within a 30-minute drive of another Chuck E., it cannibalizes the other store and shares some of that traffic. This one didn't. So it's an amazing opportunity.
So have you thought about doing any other ways to leverage the brand? I mean, obviously, for people of a certain generation, Chuck E. Cheese himself is sort of iconic, and you probably know where I'm going with this. I mean, can it be more than just a store? I mean, can it be merchandise? Can it be, you know, intellectual property in sort of a you know, movie, TV format, anything like that?
Absolutely. You led me right into that one, because in 2020 we brought in a guru in that space. You know, her whole career has been media and licensing. We are a licensing media engine. You know, we've got food products, we've got clothing, apparel, toys. But the most exciting piece is, as you said, that media. If you look at Chucky, his Q score, his rating, his awareness among families and kids, it's on par with every other character you've ever heard of. You know, we can list them all out. But superheroes, you know, all the other entertainment characters, he's just as well known as they are. And kind of the proof in the pudding for that was we had our very first holiday special. It released last Thanksgiving, 45-minute animated special, Chucky and all of his friends, and it was an astounding success on the broadcast partners that we had. So now, finally, people are saying, wow, there is a there, because if you look at that other cast of characters, they all have multiple feature films. They all have an entire catalog of DVDs and animated specials. Chucky doesn't. We've got all of that potential to unpack with a character known around the world.
And our thanks again to Chuck E. Cheese CEO Scott Drake. If you were wondering, the mouse's full name is Charles Entertainment Cheese. He began his life as a rat, but he has been a mouse since 1993, according to Wikipedia. Still ahead on The Close, what investors need to watch for over the next 24 hours, we'll tell you next. This is The Close on Bloomberg. Let's take a look ahead to what else we're watching over the next 24 hours. The day starts at 8:30 in the morning with that U.S. June jobs report coming out on a Thursday, of course, at a very interesting time for the Federal Reserve. That brings us to 10 a.m. when we get a little bit more in the way of economic data in the form of factory orders. We'll also get an update on durable goods as well. And then, surprise, 2 p.m. Eastern, the U.S. bond market closes early ahead of the July 4th holiday. Don't worry, you'll still be able to trade equities a normal day when it comes to equities. But of course, the market is closed on Friday. That's why we're having the rare Thursday jobs report. So it'll be interesting to tune in and see what happens there. But that does it for us on The Close. Balance of Power is up next. Have a great evening. This is Bloomberg.